What if your index fund could think for itself? Imagine a fund that still follows a roadmap, but chooses a smarter route when traffic piles up. That is the idea behind Smart Beta ETFs. And in the next few minutes, you'll learn what they are, why they exist, and how to pick one wisely. Stay with me until the end for a simple checklist you can use today. Traditional index funds are like a schoolyard game where the tallest kids always get picked first. In markets, that means the biggest companies dominate an index because they have the largest market values. Smart Beta flips the script. It still follows an index, but it uses clear rules to emphasize traits or factors like quality, value, momentum, dividends, or low volatility. Think of factors as ingredients in a recipe. The dish is still pasta, but you choose the sauce that fits your taste and diet. Here's a quick tour of common Smart Beta styles. Equal weight gives every stock the same seat at the table, not just the giants. Dividend growth focuses on companies that steadily raise their payouts. Low volatility prefers stocks that have historically moved less, aiming for a smoother ride. Quality screens for strong balance sheets and consistent profits. Value tilts toward stocks priced low relative to fundamentals. Each approach changes the mix, and that mix changes how your portfolio behaves. A concrete example helps. Picture two baskets of the same 500 stocks. In the first, the biggest names are heavy bowling balls that pull the basket in their direction. In the equal weight version, every stock is the same size marble. You still hold the same companies, but the ride feels different because the weights are spread out more evenly. Another example is a dividend growth ETF, which picks companies with a track record of raising dividends year after year. You're not chasing the highest yield today, you're looking for reliable growers. Now, the truth. There is no free lunch. Smart Beta funds make active choices with rules, and rules can fall out of favor. A low volatility tilt can lag when markets race higher. Value can trail during growth-led booms. Fees may be higher than a plain market index. Turnover can lead to bigger trading costs and taxes. And any ETF can deviate from its benchmark, so you should watch tracking difference, not just the headline strategy.
Here is your end of video checklist. Simple and practical. 1. Know your goal. Do you want smoother returns, more income, or diversification away from the market's biggest names? 2. Read the index methodology. Make sure you understand how the ETF defines and measures its factor. 3. Check costs, expense ratio, historical turnover, and typical bid-ask spreads. Lower, simpler, better. 4. Compare tracking difference to the index it follows. Smaller gaps are generally better. 5. Look at diversification. Avoid funds that concentrate in one sector without a reason you accept. 6. Set expectations. Factors can underperform for years. Commit only what fits your time horizon and risk tolerance. 7. Fund it like a habit. Use regular contributions and a calendar-based rebalance so your process is stronger than your mood. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. Smart Beta is not magic. It is a toolbox. Pick the right tool for the job, use it consistently, and it can help you build a portfolio that fits you better than a one-size-fits-all market cap index.